videos, um, almost, I want to sort of call it a care package, a COVID-19 care package, um, just with sort of a brief outline of a lot of the topics that I discuss. While we've got the time and while we've got the ability to, it feels like a good opportunity to share that with you. It will be very basic. It's not going to be too in depth, and it's really for a lot of the guys that are in the VRP group as well as just the open Telegram group. It's going to clear a lot of questions up. A lot of things we talk about, unfair auctions, liquidity, the book, the elusive book. They're all things that whilst I was talking to a friend of mine yesterday, as an experienced trader or as somebody that has done research in the markets and things like that, you understand what the book is and you understand what liquidity is and the buy side and the sell side. But then there are a large majority of people who don't understand what that is and they've never actually seen a visual representation of that. So it's very easy for me to say the book's looking thin on the bid or the liquidity is thin on the offer, whatever it may be. But what does that actually mean to somebody that has never seen that firsthand, or even on uh, a video or a picture or from other traders that you've spoken to? How can you relay that into your trading? And what we really need to do is, as a trader, we need to just constantly evolve our knowledge and expand our knowledge and understanding. There's no holy grail, there's no this, there's no that. It's simply piecing together parts of the puzzle to generate an understanding big enough for you to execute, whether it be on market structure or liquidity or whatever it may be, and of course profit from doing so. So we've seen a few of these examples. The things I'm going to speak about, we speak largely about it in the VRP mentorship and in the VRP chat. It's, as I say, not too in depth, and I think there is still some clarity needed for that. The other thing to remember is as well, a lot of you guys are trading on either the Forex or the CFD markets. So you're not trading on the direct market as such. You don't have access to the futures data. You don't have access to the futures platforms. Uh, you may have seen a post I put on Instagram recently, just this morning, um, of just a rough pricing package of one of the top vendors for futures trading. So conveniently, it is the system that I'm using at the moment. It's just a simulated price feed. There's no real. I haven't paid for this. There's no real orders. It's all simulated essentially. I don't have any real orders to put into the market on this account. You can all, um, the website's there. I don't want to mention it publicly, of course, but there is. If you want to go and try the demo and the same demo and have a feel for how the book works and how the order book works, um, by all means go ahead. There are many different vendors. There's all these uh, various platforms. The key thing with the futures is it's all centralized orders. So regardless of if you're using platform X, Y, or Z, all of your orders will be routed to the same place because it's all centralized at the exchange. So, and that's what we mean by the open market, as opposed to if you're trading on the forex markets or the CFD markets more accurately. It's all traded in house. You're not having access to the open market essentially. You're trading on your broker's price feed, which is why you don't have to pay for. With a lot of the brokers, you don't have to pay for data fees and routing fees and such things. Um, so when it's what do I mean by it's all traded in house? So the larger the CFD broker, um, the in theory the more liquidity that you have there, because if the broker wants to take on risk without the ECN regulation and the ECN market, um, efficiency and all these things out of the equation, if the broker wants to take on risk, they can trade against the client. If they're not interested in taking on risk, if the algorithm decides we've got a heavy book, we don't want to take on any more risk, then the trade will be matched in-house with with another client. So you're trading as a group rather than on the open market and the direct market, um, which is what we see here. This is all, albeit simulated, but this is all direct market access. This is all price feeds direct from the CME. We're looking at the moment at the GBP USD futures of the June contract. It works in essentially the same. I'm not going to give you a rundown on how to um, use the platform and how to operate the platform. The key thing to take away is that when we talk about the book, let's just go to the chart just to make things even clearer. This is what we mean when we talk about the book. So these are the actual orders sitting in the market at the moment. We don't know if they're real. We don't know if when I say real, I mean we don't know if they're intentional uh, trades. They may just be false volume or false orders. For example, if I, you know, put an order in up here and then decide suddenly to just quickly pull the order, that's going to imply to the market that there is a seller up at this price, but that I've already pulled the order, so it doesn't actually hold any sort of relevance um, to price. It is just simply the orders that at current people are willing to either pay or to sell to one another. It's quite a thin liquidity market. The currencies, the futures, they're not overly heavy. So if I just bring up a new, we call this the DOM. This is called the depth of market or a price ladder. It's generally referred to as a price ladder. I'm just going to bring up another DOM. This is the S&P now, so we're really quite thin on depth in the market. We've got 100 lot there, which is quite nice to see, but it's not what we used to. And prior to that, the S&P, there was a time sort of around 2015, 2016 that the S&P would have 3,000 contracts on each price. So we would have a substantial amount of liquidity, buy side and sell side, resting in the depth of the market in the price ladder. Um, the drop off in liquidity, even just looking at the S&P right now, you can see the erratic price movements, albeit they're not large at the moment. We're only trading from 25.15 halves to 25.17 75. So it's not like it's a huge movement, but it's the churn that we are having. So we're trading up and down in a small range. What happens here is, and we'll show you an example, be able to show you a good example of this, is if somebody has a large order to fill, let's just say, like what we just saw in the S&P, we have 100 contracts to fill. Let's just say we have 500 or 599 contracts to fill. If it will let me trade that, what we'll see, assuming that we want to buy the market, let's just say we want to buy the S&P. I can put the bid. Let's put the bid at close to market. Okay, we're going to do 100 lot clips. So we want to pay 25.15 evens, say. So we can put our bids in here. So I'm bidding 100 lot, 200 lots, 300, 400, 500. Let's just put 500 lots in the market. You can see there on the resting bid that we have 524 contracts to fill. So I can now pull that, and we've gone back down to just 26 or 24 on the bid. So we'll put another bid in. We'll do it closest to market this time so we can get a feel, or try to get the feel. And what I'll try and highlight here is the chasing of price. So let's just assume I do want to try and get the feel here at 25.16s. So I'll wait just a little longer just to see what price does, because I want to show you that the price will only move if there's enough orders to move the market. So watch what happens when we approach the 25.16s. Okay, let's just move the market order up. We're at 17 and a quarter now, so we'll try and see, and we should see this 500. If we start to trade 17 and a quarter, we'll start to see this 500 lot here trade down, because that's my order being filled. So I've got 500 lots that I want to fill, and the more people that are into that's the fill noise. That's quite annoying if you can hear that. But see, I was only filled on one contract, so I only out of 500, I was only filled on one contract there. So we can be patient. We can just sit and wait, or we can just chase the price again. So pay 18.50s. See if we can get the fill up. Let's cancel that because it's annoying. But you can see how the market won't trade lower until that order has filled or been pulled, which is what I done. I traded 85 contracts in quick succession at 18.50s, 18.5. When I pulled the order, the market moved lower. So again, let's just put in another large order here. Let's just try and turn off the sounds on that, because it was really quite irritating. So let's see if we can get the fill now at 16 and 3/4. So you can see I'm getting the fills and getting the fills. The market's obviously traded higher, so I'm now not getting the fills. Let's chase price a little bit. We'll go to 17 and 3/4. Okay, you can see here now that I'm still the best bid. The price is trading my bid. And watch what happens when my bid's filled. This is all simulated, of course. This is just a simulation. 92 contracts left. 50, 49. Okay, and then you can see the price, the orders return back to the market. The liquidity's turning back into the market. They've filled a large order at 17 and 3/4, and now we can continue auctioning lower. So assuming this is real, I've now filled 370 contracts long. Yes, this is a large position for an individual person, but this is the sort of contract size that people, this is nothing. 370 lots basically is nothing. People will trade that all the time. People will hit 1,000 lot clips in the S&P, and this is what happens when, if I can just change the settings on here, count orders. I'm going to try and use, I think it's just letting me only give me a maximum of 100 contracts, which is not a problem, but okay, we'll just leave it at that. So, assuming we have 370 contracts long in the market now, we're offside, so we paid 17 and 3/4. We're trading 15 and 16 evens. We want to take a loss. We just want to hit the market and we want to take a loss. So this is what happens when somebody, we call it puking, and just gives up. We think, right, we're wrong. We just need to close the position. We might even turn a profit here. We just want to close the position. We just want to liquidate all of our open positions. This is what we have. see how we've just instantly low ticked the market down here at 25, and then we've jumped back up to return trading where our liquidity is. That's essentially the book, and that was only 100 lots. We've still got 270 contracts left to fill, so we can do the same again. We want to sell 2518 halves or 100 contracts. There's not 100 contracts on this market at the moment for 5 prices down. So we will move the market if we close this position. We'll do it again. See how the current market is trading down here. It's filled. We can now return back to where we were trading originally. We've still got 170 contracts to close. So now, from a trading perspective, we're in the money. We're 170 contracts in the money for quite a substantial amount. So what we'll do is we just want to close the position and take our profit. So we close the position again. We're trading, and the market will continue to trade our price, and we'll hold the market there until, there we go, the order's filled and liquidity can continue going higher up. So we'll close off the last 70 contracts. We'll just hit market again, and obviously we're holding the market here. Oh, we're going to be short now, so 70 contracts. Okay, so we've got 100 contracts short by accident. So I'm just going to close that off. Doing the same again, I'm just going to close. We haven't got 100, these numbers here on the offer, which we need to buy from, doesn't total. I mean, up to here, that yes, it may, overall, it may total 100. So if we trade 100 there, we'll get the fills. But if we want to trade 100, and the maximum price we want to pay is just say 26.25s, we can pay that. There we go, and we're holding the price until the order is filled. And this is what happens. So in a thin liquidity market, large orders will drastically move price. We can be patient. We can sit with 100 lot here and wait for the price to fill us. Or if we're a broker, or if we're a large institution and we've had a mandate to fill a client order at best price, our best price is, if we deem the market to be going higher and we're trading 28 evens, we need to just buy the market. So we're just going to buy. So if we just buy, you can see we're stripping the market. So large institutions do have quite a drastic influence on low liquidity markets. The same can be said with, of course, the currency. So if we have 120 lots short at the moment, let's try and buy back. So we need to buy from the offer. We need to buy back these contracts in a relatively low liquidity market. So there we go. We just buy the market, and we've just high ticked everyone. The market won't resume trading normally until the order's filled, or until I pull the order, in which case we'll see the liquidity return back to the market and continue trading. But I don't want to cancel the order. I want the remaining 34 contracts to be filled. So I'm just going to buy, and there we go. I'm going to close the position off entirely. If we try and do that on something like the 10-year government bond, the T-note, we have 100 contracts. We have a mandate from a client to fill at best price on the short side, so we need to sell to the best bid. If we do that, we're not going to make a dent in the market. I don't have trading rights for this. Oh, I do. I've just sold. There we go. We've got 100 contracts traded, and I'm now short 100 contracts. If I need to take a loss on this position, and I'm just going to buy back for a 1 tick loss, just for argument's sake, I'm going to buy back. There we go. And the price hasn't moved. And even if we decide to try and strip the market, so best bid at the moment, we've got 139 and a quarter trading for 134 lots. So if I'm just going to sell the market, and if I'm going to try and sell down to here, nothing actually happens. The price doesn't move, and I'm short 100 contracts because there was enough liquidity on the bid for me to fill that order without searching for that liquidity further down. And there we go. So we're now ticking up. So let's just say I need to take the loss. We'll do the same. I'm just going to buy. I paid 139s, 35s for 100 lots. I took 2 ticks on the loss, which is quite substantial in the USD notes, and the price didn't even move. We took a large chunk of the offer down because there's only 30 contracts remaining, but it didn't tick up or tick down. Whereas if we was to do that on the S&P or the currencies or even oil is very similar here at $20. We will impact or influence the market price